I think the biggest or the most interesting issue that's going to evolve in 2017 is going to be the way inflation comes through, the size, the magnitude, and then the market's reaction to it. So just to be clear, we should see a bottoming of global inflation about the first quarter of next year as energy prices will roll over the basing effect of last year. In the US in particular, we've seen a pickup in wage inflation, and even here we clearly have signalled electricity rate rises. The GDP numbers, weak as what they were, indicate that wage growth is starting to emerge again a little bit here. So all in all says that inflation is going to go up. Now, we just need to bear in mind, we're not talking about 6 or 7 or runaway inflation. We're talking about inflation going up maybe from 2 to 2.5 to possibly 3%. But that is a significant shift from where we have been, and a lot of discussion about deflation. And in turn, it has repercussions everywhere in terms of the rate environment, in terms of the kind of equities you should have, pricing power equities. So it's going to, in my opinion, there'll be other influences, but this will be a fairly predominant influence throughout the year. Well, rates will often try to predict these. Most of these sort of financial market nerds will spend time looking at things like inflationary expectations and the TIPS market in America, the Treasury protected inflation, and try to work out where they can position themselves accordingly. It's quite likely that rates will possibly run a little bit ahead of the inflationary trajectory. So we may well see, a race up in bond yields rising, bond prices falling, and then giving up a little bit and then retracing ground. So it's probably going to be a patchy move just until there's some conviction that it will come about. But it implies rates probably globally will be higher and possibly higher than expected at the end of next year. Even here, notwithstanding weak GDP numbers, I wouldn't be surprised to see people start talking about a rate rise in the second half of next year, compared to some who still believe there's a rate cut that could come through. I'd be very surprised. I think on the equity market specifically, the one that I think will be closely watched is, can revenue growth come through? I think we've done, beaten ourselves on the chest in terms of cost cutting and restructuring. That can only go that far. Unlike the US, we don't have a kitty bag to do buybacks because companies are not terribly cash flow flush here, and the dividend payouts are so high. So it's got to be revenue growth. Now, revenue growth has apparently picked up in the market, but it's been predominantly driven by the resource sector at this point. What we'd want to see is some more broadly based revenue improvements coming through as companies sort of find their mojo in terms of how they position themselves in markets, where demand really lies, rather than sort of, gazing around wondering about what monetary policy is going to do for them. I think the big risks next year still remain political. In fact, you could argue that that's probably government risks are probably the ones we're going to spend some years talking about. But European elections are unquestionably this event risk political spectrum of next year. We don't know exactly what the US administration is actually going to truly do once they're in power. It's one thing to say things, it's another to actually execute it through Congress and the House of Reps. And as we know here domestically, it's not that sure. We have China's Politburo going under a major change in personnel. So I think it's mostly about political risks, as opposed to the past 10 years where we've lived mostly through central bank risks. Those are probably going to be a second tier to government type risks in the coming year.